Welcome traders to your essential gold forex trading analysis for the week of June 16th to 20th, 2025. Last week presented some compelling moves in the gold market. Today we'll break down those movements using our key technical indicators, stochastic, MACD, and Fibonacci retracement, to identify potential opportunities and challenges for the days ahead. Looking back at the week of June 9th to 13th, gold initially experienced some pressure, dropping to around the $3,308 mark on Monday, June 9th. This was influenced by optimism surrounding U.S.-China trade talks and a strong U.S. jobs report, which reduced safe haven demand. However, the sentiment quickly shifted. From June 10th onwards, we saw a significant rebound. Gold broke out of a bull flag pattern and retested prior resistance as new support around the 9th, which then triggered a strong rally. By Friday, June 13th, gold had surged, with some reports indicating it almost touched the $3,430 resistance area, driven by escalating geopolitical risks, particularly reports of Israeli preemptive strikes on Iran. This pushed gold into an uptrend, eyeing new record highs. Let's bring in our first indicator, the stochastic oscillator. As you can see, early last week when gold was declining, the stochastic indicator likely moved towards or into the oversold territory below 20. This signaled that selling pressure might be excessive, and a bounce could be imminent. As the week progressed and gold rallied, the stochastic line crossed above the oversold threshold and pushed significantly higher, indicating strong buying momentum. For the current week, if gold continues its upward trajectory, we'll be watching for the stochastic to move into overbought territory, above 80. While this doesn't guarantee an immediate reversal, it suggests a potential for a pullback or consolidation as buying pressure becomes extended. Conversely, any dip bringing stochastic back towards the oversold zone could present a buying opportunity, especially if supported by other indicators. Next, let's analyze the Moving Average Convergence Divergence, or MACD. At the start of last week's decline, we likely saw the MACD line cross below the signal line, and the histogram turn negative, confirming bearish momentum. However, as gold reversed course and surged, a bullish MACD crossover would have occurred, the MACD line crossing above the signal line, and the histogram would have turned positive and increased in size, signifying strengthening bullish momentum. For the week of June 16th to 20th, we want to observe the MACD lines. If they remain above the zero line and the histogram continues to expand upwards, it reinforces the bullish trend. A potential concern would be if the MACD lines converge, or the histogram starts to shrink, indicating a loss of momentum, even if prices are still rising. A bearish crossover, where the MACD line drops below the signal line, would be a strong sell signal, suggesting a potential trend reversal. Finally, let's incorporate Fibonacci retracement, which is, honestly, a pretty powerful tool for identifying potential support and resistance levels. Given gold's strong rally last week, we would draw our Fibonacci retracement from the low point around June 9th to the high reached on June 13th. Now, the key retracement levels to watch for this week are the 38.2%, 50%, and 61.8% levels. These zones often act as magnets for price during a pullback, so, if gold experiences a retracement this week, we would anticipate potential support around these levels. A bounce from the 38.2 or 50% level would suggest a strong underlying bullish trend. On the other hand, a deeper retracement to the 61.8% golden zone could still be a healthy pullback, offering a pretty good buying opportunity before a continuation of the upward trend. But a break below the 61.8% level would raise concerns about the short-term bullish bias. Based on last week's strong performance, fueled by geopolitical tensions, gold enters the week of June 16th to 20th with a clear bullish bias. The rally last week saw gold testing the $3,430 resistance area. If gold bulls can sustain a break above $3,430, the next target could indeed be new all-time highs above $3,500, with some analysts even suggesting $4,000 as a potential long-term target. Combining our indicators, first stochastic, we'll be monitoring for overbought conditions, which could signal a temporary pause or pullback. Next MACD, A continued bullish crossover and increasing positive histogram would confirm the strength of the uptrend. And for Fibonacci retracement, any pullbacks this week should ideally find support at the 38.2, 50, or 61.8% levels to maintain the overall bullish structure. However, traders should remain vigilant. While geopolitical tensions provide strong tailwinds for gold as a safe haven asset, any de-escalation or stronger than expected economic data could temper its ascent. Also, profit-taking after last week's strong rally is definitely a possibility. For traders looking to enter or manage positions this week, here are a few things to keep in mind. For potential long entries, look for pullbacks towards Fibonacci support levels, 38.2, 50, or 61.8%, accompanied by bullish candlestick patterns and a stochastic crossing up from oversold or neutral territory. For confirmations, a sustained MACD bullish crossover and positive histogram reinforcement would be ideal for long entries. When it comes to resistance, watch the $3,430 level closely. A decisive break above it opens the door to higher targets. For risk management, always place appropriate stop-loss orders. For long positions, consider placing stop losses below key Fibonacci levels or recent swing lows to protect your capital. And of course, be mindful of sudden shifts in geopolitical news. That wraps up our gold forex trading analysis for the week. Remember, effective trading involves continuous learning and adapting to market conditions. Stay disciplined, manage your risk, and happy trading.